The SEC and FINRA have issued an investor alert about selling pensions or structured settlement income streams. My guest is attorney Matt Bracy with the firm of Nesbitt, Vassar and McCown. He's considered an expert in the settlement purchase industry as he's been involved in it for the last 14 years. He's also the former president of NASP. Matt, welcome back. Let's begin by talking about what exactly this alert says.
Well, the fact that the bulletin exists at all, frankly, troubles me, not because I don't think people should have information about structured settlement factoring, and investors who want to buy payment streams that are factored should certainly know all kinds of things. The problem with this bulletin is it takes really 4 concepts and mixes them all together, and it's a little bit hard to tell which one they're talking about at any given time. And what I mean by 4 is they first of all, they combine on its face the process of purchasing pensions. And this is something that's fairly new and somewhat controversial in some circles. I don't really know much about it, to be honest with you, which should be an indicator that it's very different, very distinct from structured settlement purchasing. And so they've combined this pension purchasing product and also the structured settlement product together. And then they've talked about, really, for each of those, 2 different aspects of it. One is people who want to sell payments in a structured settlement context, or sell their pension payments. And they've also talked about people who want to buy them on the back end, let's say, as investors who want to invest in those. So you've got these 4 concepts that have been sort of muddled together and mixed together, and it creates a very confusing read. I don't see any reason to combine those 4 things, or even the 2 main areas of structured settlements and pensions. They're distinctly different.
Well, Matt, this seems like it's covering 2 completely different things here. We have settlement purchase, which is most likely something that's been given to an injury victim. Selling settlement payments is a court-approved process. And then we have an individual selling future pension payments.
What you just said is a perfect example of the muddle. And this is why this is so destructive. When you're trying to zero in on who's being talked about here, it's not clear if you're talking about often an investor trying to buy a structured settlement factoring stream, let's say, or a person who's trying to sell a structured settlement stream of payments to a factoring company, or you're talking about someone who's trying to sell their pension payments, or someone who's trying to buy that sort of product on the back end. It's not clear. And so you just mentioned court approval, for example. Well, court approval comes in when someone wants to sell their payments, their structured settlement payments. And so they have to already have a structured settlement. Now, most structured settlements are not court approved. And so when they're set up, the initial setup of a structured settlement is not court approved typically. Several are, and certainly if there's a minor involved, they are approved by a court. However, a large number of structured settlements out there in the world are never approved by a court when set up. Now, every structured settlement transaction, when it's factored, when payments are sold, must be approved by a court. So that's the distinction. And oftentimes in this memo or this bulletin, it's not clear at all who they're talking about.
So what do you think in your mind is misleading about this?
In the bulletin, because all these concepts are mixed together, it's not very much a clear statement to anyone about what their rights are or what their obligations are or what to look out for. So it kind of fails at the outset. One of the examples of this is the concept of, and sometimes frankly it misstates facts. One of those facts that it misstates is, or casts in a strange light, I will say, is the idea that court approval for factored structured settlement payments. So someone has a structured settlement, they want to sell payments, they sell them, they enter into an agreement with a company to buy them, a factoring company. That transaction must be approved by a court that looks at the details of the transaction, decides it's in the person's best interest, taking into account the welfare and support of any dependents, in addition to complying with other aspects of state law like disclosures and advising the person to seek independent professional advice, and they can usually in most states receive that advice or waive it. That's the structure. That's how this all works. One of the problems with this memo is it kind of glosses over the court approval process and suggests that some states require this or almost all states require it, which is not true. It's required in every circumstance, and that's because of the intersection between federal law, Internal Revenue Code 5891, which mandates that there's a very punitive excise tax attached to any transaction that's not approved by a state court. So every transaction is going to be approved by a state court. So that's one example. Another example would be they raise the issue of sort of this it's not clear whether or not there's going to be a tax problem. And again, it's not clear to me from reading the bulletin who exactly they're talking about at that time. But let me say this, for structured settlement recipients, structured settlement personal injury victims or claimants who are in a structured settlement receive those payments in federal income tax free. Once they sell their payments, the lump sum that they receive from a factoring company is likewise federal income tax free. That is very clear. So there should be no misunderstanding that it's tax neutral. There is no negative tax consequence for people who sell their payments. However, if now we're talking instead about the investors who buy them, that is an investment that will be subject to normal tax consideration, capital gains or what have you. I'm not a tax lawyer, and I'm certainly not giving any tax or other legal advice, but I will tell you that there is little question in my mind, if I were buying them, that would be a normal investment and subject to taxation. So raising the issue of there might be a tax problem here is a red herring, or maybe it's a misstatement or a misunderstanding, but it's not clear, and it does not help anyone understand how this all works. So those are examples of two things that the bulletin sort of either has wrong or leaves a very bad impression. I mean, the choice of terminology in the bulletin, I will tell you that it's unfortunate. And what they talk about sometimes, and again, it's hard to tell if they're talking about pension buyers or they're talking about structured settlement factoring companies, but they say things like, if you have these payments, you might be targeted by salespeople. That's obviously a negative connotation. They also talk about how the lump sum you receive will be less than the total of the periodic payments you would otherwise receive. To me, that's very obvious. If you took a calculator and added up all the payments over time due on, let's say, a structured settlement, and you came up with a number, if you try to factor those payments, they go out, let's say, 15 or 20 years, of course the number you get is going to be less than the total of the calculator of all those. Because time value of money, $1 today is worth more than $1 in 15 years or 20 years. That's basic concept number one. Basic concept number two is the companies who offer those lump sums are for-profit businesses. So of course there's going to be profit built in. Now, whether or not the transaction is fair and reasonable, well, that's something that's going to be up to a judge to decide when deciding if it's in the person's best interest or not. And so this sort of this terminology and this negative connotation that the bulletin uses quite often for this is quite disturbing. And then making statements like, these investments can be risky and complex. Obviously, this is very complex because they've got it pretty wrong in a lot of circumstances. It's not terribly complex. It's understandable. I'm not sure if it's more complex than a mutual fund or things like that. Maybe it is. But certainly all investments are risky. And I think anyone would be well advised to carefully consider any investment. I'm not sure why it's important to single out these two classes that are mixed together inappropriately. I'm not sure I get that.
Well, Matt, is there anything else you would like to add?
Sure. I'm absolutely not saying that people should not be informed of the process and the complexities and even the risks involved in both selling your payments and also if you're an investor deciding to invest in a factored structured settlement payment stream. What I'd like to see, though, is more clear information. It's very unfortunate that the SEC and FINRA could not put out a piece that was more clear and more comprehensive and more helpful, frankly.
Matt, thank you.
Thank you.
My guest has been Matt Bracy with the firm Nesbitt, Vassar & McCown, and you're watching the Factoring Channel, an affiliate of the Legal Broadcast Network.